Let's start with private equity basics. Private equity refers to investments made in companies that are not publicly traded. These are usually mature and established businesses. Investors pool their money together and often take a controlling stake in the company. That means they actively take and influence decisions. Uh, the main goal of private equity is long-term value creation. They improve operations, increase efficiency, and later sell the company at a higher valuation. So remember, private equity it focuses on stable businesses and structured growth. Now let's understand what types of companies private equity actually targets. It targets or usually invests in medium to large companies that are already generating revenue but may need expansion capital, restructuring, or operational improvement. These investments may include acquisitions, growth funding, or buyouts. Unlike venture capital, private equity generally avoids early stage startups. They prefer businesses that have already been proven. So, the key idea here is established companies, not new startups. So this slide basically explains how private equity deals are structured. Private equity firms often buy a controlling share or sometimes the entire company. They use a combination of their own capital and borrowed money. This use of borrowed funds is called as leverage. One common structure is called a leveraged buyout, where debt is used to finance a large part of the acquisition. After acquiring the company, they may restructure operations, improve management, cut costs, and increase profitability before eventually exiting through resale. So, deal structure plus leverage is equal to key concepts in private equity. Now, let's move to venture capital. Venture capital, it focuses on early stage companies, usually startups. These companies may have innovative ideas but limited operating history. Venture capitalists, they invest in exchange for equity and often take minority stakes rather than full control. They also mentor founders, provide strategic guidance, and help with networking and future funding rounds. So, venture capital, it's more about nurturing ideas and scaling innovation. Venture capital involves higher risk compared to private equity. Many startups actually fail. In fact, only a small percentage actually become successful. However, the returns on successful investments can be extremely high, especially when companies go public or get acquired. For example, early investors in companies like Uber or Airbnb earned massive returns. So, venture capital actually follows a high risk, high return model. To conclude, I think both private equity and venture capital aim to generate profits by investing in companies. However, the stage of investment, level of risk, and involvement differ significantly. Private equity invests in mature businesses and focuses on operational improvements. Venture capital, it invests in startups and focuses on innovation and growth. Understanding this distinction is very important for anyone interested in finance or business careers.